In today's financial world, it feels like we're just drowning in information, right?
Mm,
Trying to figure out what actually moves stock prices can be, well, overwhelming.
it really can. There's just so much data flying around.
Exactly. So, for you trying to make sense of it all, our mission today is to cut through some of that noise, taking a deep dive into a really interesting study. It asks this fundamental question. When you're trying to predict stock returns, is it always better to use global data, cast the widest net possible?
Or is focusing just on the local market data enough?
Precisely. And this isn't just guesswork. We're looking at some serious research, spans 30 years, 45 different markets. They analyzed tons of stock data, 147 different stock characteristics.
That's a massive data set.
So the core question they're tackling is, does more data, the global stuff, actually give you a significant edge? Or is a deep understanding of local markets, powerful enough on its own?
It's a critical question, and this study gives us a really solid data-backed answer, or at least a strong perspective on it.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, let's get into the how. They didn't just, guess this stuff. They used machine learning, right? Specifically, something called the elastic net model.
That's right, the elastic net.
Now, for maybe some listeners less familiar with ML, what is that exactly, and why pick that tool for this job?
Sure. So the elastic net is basically a statistical technique. It's really useful when you have a lot of potential predictors, like those 147 characteristics, and you need to figure out which ones actually matter.
Okay, sort of like finding the signal in the noise.
Exactly. And importantly, it assumes a linear relationship between the characteristics and expected returns. This lines up nicely with, traditional finance ideas like factor models.
So it bridges the gap a bit between new methods and established theory.
Right. Think of it like this. You've got 147 ingredients. The elastic net helps you pick the handful that actually make the cake taste good and tells you how much of each to use. It also ignores the redundant ones.
Good analogy. And it gives you coefficients, right? So you can compare how much each factor matters in different places.
Precisely. That comparison across markets is key to the study's goals.
Makes sense. So how do they actually operationalize this? How do they apply this elastic net across all those markets and all that data?
They were very systematic. First, for each characteristic, they ranked the stocks within each country.
Okay, so relative ranking within a market.
Yes. Then, to make things comparable across different countries, they scaled those ranks to fall between -1 and 1, standardizing it.
Gotcha.
Then, for the actual model training, they used what's called an expanding window approach.
Expanding window.
Yeah, so instead of just using a fixed historical period, they started with a minimum of 10 years of data. Then, every year, they retrained the model, adding the latest year's data to the existing history.
So the model learns and adapts as markets change over time. That sounds much more realistic.
It is. Markets aren't static, right? And crucially, they used the model trained up to a certain point to predict returns for the next month, data the model hadn't seen before. That's the out-of-sample testing.
Right, the real test, to make sure it's not just fitting past noise.
Exactly. It ensures the results are more likely to be robust going forward. They also mentioned comparing their setup to another study, Hellam et al., from 2023, highlighting that this study used more markets and more recent data.
Okay, so building on previous work, but with a broader scope. Now let's get to the juicy part, the results. The study talks about this concept, the global training premium. What exactly is that?
Right, the global training premium. It's basically the extra return, if any, that you get from using a strategy trained on data from all markets, compared to just using a strategy trained only on data from the specific local market you're interested in.
So the added value of going global, what did they find? Was it huge?
Well, this is maybe the most surprising part. The central finding was that, on average, the globally trained models performed remarkably similarly to the locally trained models.
Really? Similar? Across countries, regions, sectors?
Pretty much across the board. They looked at long-short strategies, buying predicted winners and shorting predicted losers. The abnormal returns, the alphas, were very close, like 0.94% per month for local versus 1.03% for global, roughly.
Wow, that's not that big gap at all.
No. And they looked at Sharpe ratios, too. That's return adjusted for risk. Again, very similar on average across countries. Local models average a Sharpe ratio of about 0.88, global models about 0.92.
So very marginal difference in risk-adjusted terms as well.
Very marginal on average. Now, there were some nuances.
Okay.
Regional models, so training on data just from Europe or North America, for example, sometimes did slightly better than the full global models.
Interesting.
Yeah, the average Sharpe ratio for local regional strategies was 1.06 compared to 1.01 for global. There was also this idea of regional transfers that did well too, around 1.07. When they looked at sectors and industries, though, the global models did show a slightly clearer edge. Higher Sharpe ratios like 0.95 versus 0.82 for sectors and 0.84 versus 0.74 for industries compared to locally trained sector industry models.
Okay, so a slight advantage there, but still, the overall picture is similarity.
Exactly. And the similarity held up whether they looked at big companies, small companies, even tiny microcaps. It also held up across different time periods, the earlier part of the study versus the more recent decades.
And you mentioned something earlier. Did they notice any trend over time?
Yeah, they noted a slight decline in the apparent value of global data more recently. The gap, small as it was, seemed to shrink a bit over time.
Okay, so the big takeaway for you listening is getting bogged down in massive global data sets might not give you the huge predictive boost you'd assume compared to really nailing your local market analysis.
That seems to be the main message from the performance comparison.
But the study did dig into when that global training premium, small as it is, might actually show up more clearly, right?
Yes, exactly. That's where things get a bit more detailed. So while the overall value-weighted premium where big markets dominate, the average, was low and often insignificant.
Meaning not statistically reliable.
Right. But when they looked at things on an equal-weighted basis, giving small markets the same weight as large ones, then the premium became more noticeable, sometimes statistically significant.
Ah, so it suggests global data might be more helpful for understanding smaller, perhaps less information-rich markets.
That's the implication. If a local market has less data to begin with, pulling insights from the global pool might add more value. The same thing seemed to happen for smaller industries with fewer companies. The equal-weighted premium was more evident there, too.
That makes intuitive sense. Less local data means global patterns might fill in the gaps better. How did they actually measure this premium? You mentioned a test.
Yeah, they used a statistical method called a spanning test regression. It's a bit technical, but the idea is basically to see if the returns of the local strategies can fully explain the returns of the global strategies.
Okay, so if the local strategy explains everything, there's no premium.
Exactly. Any leftover return from the global strategy that the local one can't explain, that's quantified as the global training premium.
And the results from that test confirm what you said. Modest premium overall, but more visible in equal-weighted scenarios, especially for smaller markets and industries.
That's what their analysis referencing their Table 8 generally showed. Modest gains for value-weighted, more evident for equal-weighted.
Okay, so while global isn't a magic bullet everywhere, it might offer some edge in specific, perhaps less data-rich corners of the market. But were there potential downsides or nuances that suggest sticking local might still be smart?
Absolutely. The study didn't just say global and local are similar, end of story. It dug into why and found some important caveats.
Like what?
Well, first they looked at which characteristics the models found most important. Things like market frictions, momentum signals like the 52-week high, assets to equity, book to market.
Standard factors, mostly.
Right. And these tended to be important both globally and in most local models. So there's consistency in what matters.
Okay, that suggests some universal drivers.
But, and this is crucial, the sensitivity to these factors, the actual coefficients or slopes, could vary quite a lot from one market to another.
Ah. So the same factor might have a much stronger or weaker effect depending on the country.
Exactly. Their Figure 5 showed this clearly. The range of coefficients for key variables across different countries was pretty wide. It suggests that while the ingredients might be similar, the local recipe, how investors react to that information, still differs.
That's a really key point. A pure global model might average out those local sensitivities and miss important nuances.
It could. It points to persistent local specificities.
Did they see any trends in how similar or different markets are becoming?
Yes, they looked at that too. They measured the sort of distance between the coefficient estimates across countries over time, and they found increasing global alignment, especially for developed and emerging markets. The coefficients have been converging, suggesting markets are becoming more similar in how assets are priced.
So markets are getting more integrated.
Seems like it. Particularly developed and emerging ones, frontier markets were a bit of an exception, remaining more distinct.
And if markets are becoming more similar, does that affect the global training premium?
Well, consistent with that, they found the magnitude of the global training premium has generally diminished over the past decade or so. As markets align, the unique edge from pooling global data might be reducing.
Fewer arbitrage opportunities across markets, perhaps?
Could be part of it. They also did another analysis, a panel regression, looking at what market characteristics make the global strategies perform better relative to local ones.
And what did that show?
Two things stood out. First, high idiosyncratic volatility, that's stock-specific risk. The unpredictable noise in a stock not related to the market significantly boosted the relative performance of global strategies.
So in noisy markets, the global perspective helps filter.
That seems to be the idea. When local signals are messy, the broader global patterns might be more stable. The other factor was the number of firms, particularly in industry portfolios. Global models did relatively better in industries with fewer firms, linking back to the idea of data scarcity.
Okay, interesting. More useful when local data is scarce or noisy. Were there any other limitations mentioned?
Well, they acknowledged that they primarily used a linear model, the elastic net. It's possible that more complex, non-linear machine learning models might be able to extract more value from the sheer volume of global data in ways a linear model can't.
Right, so maybe with different tools, the conclusion could shift slightly.
It's a possibility worth noting. But based on this widely used and interpretable method, the findings are quite clear.
Okay, so let's try and wrap this up. The key takeaway for you, the listener, seems to be that while a global view is tempting, this deep dive suggests that for predicting stock returns, focusing on local data and understanding local market nuances is often remarkably effective.
Surprisingly so, yes. In many cases, it performs just as well as, or sometimes even a tad better than, complex global models.
Which has real practical implications. It suggests you might be able to avoid the significant costs and complexity associated with gathering and modeling massive global data sets.
Potentially, yes, especially if you're operating mainly in larger, more liquid markets where good local data is readily available. Focusing on mastering that local context might be a more efficient use of resources.
This has been really illuminating. It challenges that common assumption that more data is always better.
It definitely adds important nuance to that idea in the context of stock return prediction.
So here's a final thought for you to chew on. We see this increasing global alignment, yet persistent local differences in how factors play out. We see local data holding its own against global data. So where do you think the future edge in stock prediction really lies? Is it in becoming a hyper-local expert, truly understanding the unique dynamics of your specific market? Or is it about finding those remaining pockets, maybe smaller markets, maybe specific situations where global data still offers that distinct, valuable advantage?
That's the million-dollar question, isn't it? Where does the balance lie going forward?
Something to think about. This deep dive gives you a great foundation for considering that in your own approach. Thanks for joining us on the Deep Dive.